If your client is even mildly charitably inclined, there are opportunities available to them through the tax code. Our code is designed to reward charity. I'd like to take you through a number of scenarios involving charity and the tax planning surrounding that charity, with examples of each on how we would model them in Holistiplan. If your client's charity is in the range of tens of dollars or hundreds of dollars or even low thousands of dollars, traditionally they may not have thought of that level of donating to charity as something that had tax planning implications. And in general, that was largely true. I mean, it's so small that it would never really put a dent in, say, their itemized deductions. But now, starting in 2026, there is a way, even if you take the standard deduction, there is a way to still get a deduction for charitable donations. So here I have an example. This is a 2026 example. This client is taking the standard deduction. There it is, $35,500 standard deduction for 2026. This is a married couple over age 65. Let's enter some charity for them, but not a lot. Let's just say, I don't know, $550 because they gave a little bit to the kid down the street and then they donated a little bit of stuff to Goodwill. By the way, now make sure we start training our clients to think about receipts for charity. You don't need receipts for certain sizes of charitable donations, but it's really worthwhile to get in that habit, especially now that they're able to get deductions where before they may not have been. So this client is still taking the standard deduction. There was not enough charity in there to get an itemized deduction there. I entered, what did I enter? $550,000. Actually, if they were itemizing, there's a new floor that keeps them from even taking any sort of itemized deduction for that charity. But you'll see here in this other deductions and QBI section, we have this standard deduction charity, and that's new in 2026, where the client can get a standard deduction charitable deduction, even though they're not itemizing. And if I wanted to show like what's the difference between saving those receipts and recording that charity versus not, let's go ahead and copy that example. And I'll remove the charity just so we can see the difference. So here's, remove that charity, boom. Let's say that the client didn't know that they could get this kind of below the line deduction. So in case one, they get the charity. In case two, they don't get the deduction, a difference of $550. The difference in actual taxes to the client, $121, which I would argue is worth your client saving those receipts or making a record of the charitable donations they've made, even if in the past they never really got credit for those charitable donations because of the itemized deduction, the floor that they had to cross as far as the standard deduction limit. Another great example of where a financial advisor can be helpful to a client giving to charity is when there are unrealized gains in appreciated securities. If we give those, first of all, we avoid the capital gain on selling those securities, and we also get the deduction for giving to charity. So I'm going to give an example here. Here's a case where the client has, I'm going to highlight it here, $5,000 of long-term capital gains, and they also, here's in Schedule A, they also have, here we have $5,000 of cash contributions to charity. And so they're paying tax on the capital gains, but they're also getting a deduction on the charity. Let's take an example where we're going to copy that, and instead of selling the long-term capital gain and then donating the money, let's eliminate that capital gain by just giving those appreciated securities. So I'm going to keep the $5,000 donation to charity. Just for the sake of capturing it fully correctly, I'm going to put this in this line down here, which is non-cash gains donations to these limited organizations. So it's still $5,000, but I'm giving an appreciated security. And so what I can do is let's go up and we're going to clear out this $5,000 capital gain. That's no longer a taxable capital gain. So clear that out. So let's look side by side here. I removed a $5,000 gain. And I also am getting this, I'm actually getting a little bit more charitable deduction because there's an AGI floor on how much you can deduct for charity. If I go all the way, scroll all the way down to the bottom, it actually, lowering my AGI actually also helps me with my enhanced senior deduction. That has a phase out. So all said and done for this example, my client saves $442 by giving the same amount to charity. It's just that the advisor has advised this client of a different way to do it, giving those appreciated securities, and they get to save $442 in tax. That's how we can show the client the benefit of going one route versus another within scenario analysis. One case where charity planning can really help out is if your client has an abnormally large income year, some huge bonus at work or a sale of a business or some other asset. We can bring charity into a single year through the use of, say, a donor advised fund to offset that large income year. So here's an example I put in the system. This client, I gave them, here it is, another income. I just gave them a $1 million lump, huge income event. Now this is a client who is accustomed to giving, I'm going to say, what did I make it? $20,000 a year to charity, okay? Well, let's say that's generally their pattern over many years. Let's use a donor advised fund to bring a lot of those years of charity into a single year, and we can offset that huge income event. Now, I will say this, I'm not going to go into it in a ton of detail, but there are limitations as to how much income you can offset with charity deductions. And the system will calculate this for you. You may remember from the CFP curriculum, if you went through that there are different limits based on the type of donations you make and the type of organizations you give to. So just make sure that within the charity worksheet, you're putting things in the right boxes. The system will then make sure that we handle those AGI caps. It's something to be careful of. I had one case with a client who sold his business, struggled to sell the building that his business was located in. He just could not sell it. And so he ended up donating that building. The problem was the building was worth so much, and because he had retired, his income was low enough that it took several years of carry forwards for us to get full credit for that donated building. And honestly, it would have been better for him to try to donate it in the year that he had that higher income, so it could have fit within that AGI limitation. We have a donor advised fund explainer, which you could use for this exact case where there's a high income year. I can pop this open here. The donor advised fund explainer kind of goes through, here's what it actually is. This is meant to be client facing. Here's what it is. Here's how it works. And then we can actually show the client, let me just show you the total tax with and without a huge donor advised fund amount. So let's go back actually. Let's go back and let's actually put a whole bunch. Let's say we're going to take 5 years. So instead of $20,000, we're going to do $100,000 in here. So I took 5 years worth of charity and I put it all in 1 year. This donor advised fund piece can, this donor advised fund explainer can show us, look how much difference in total taxes that charity grouping did for us. In this case, it's a total tax of $336,000 versus $312,000. Pretty big savings just from our moving deductions into a single year. And then this report kind of helps the client understand like what are the mechanics of what a donor advised fund is and how we use it. Let's say your client gives to charity every year, $10,000 to $15,000, $20,000, enough that it's pretty significant, but not enough to get them over the hurdle rate of the standard deduction. And so if we don't do something as planners, we kind of like waste that amount of charity that your client does every year. So one way to do that is we use a donor advised fund to group multiple years of charity into 1 year. So here's an example of a client who, what's their annual charity? I'm going to put in, where the heck is it? Here it is. Let's say that they do $15,000 of charity per year, okay? And so their standard deduction for a married couple is in the 30,000s. So at this rate, and with their other itemized deductions, they're never really going to itemize at this level of charity. So we really should look at a donor advised fund to group charity into a single year over multiple years. So let's pop this open. Again, the donor advised fund explainer, you can use the explainer for different situations. In this case, I'm choosing the charity is lower than the standard deduction, right? So let's say that their typical annual charitable deduction, what did we say it was? $15,000. And let's say that their other itemized deductions were about $10,000, okay? So again, their total itemized deductions are $25,000, which for a married couple will never get them into itemized deduction territory. So they're kind of wasting not only the charity piece, but even these other itemized deductions. But let's say that we can convince the client to group 5 years of charity into one with the donor advised fund. You can see here side by side on the left-hand side, that's our base case, where that's if we just don't do anything. If we just continue to give the way we've been giving, we never really get over that hurdle rate to the point where we're itemizing, and so it's just a standard deduction every year. On the right-hand side, we use that donor advised fund to bring all of that future charity into 1 year. Not only does the charity become itemizable, but also, in this case, I had state income tax piece that I was going to lose also. I get to itemize that, at least in this year. So I'm pulling all my itemized deductions into 1 year. Then I go back to the standard deduction, of course. But over the course of those 5 years, I can show the client, look, you were able to add $49,500 of additional deductions that you didn't have before just by us putting all this charity into a donor advised fund in year one. There could be a case where your client is giving so much to charity every year that they actually never get the opportunity to take the standard deduction. And your client may think, oh, well, that's I'm actually doing it right. Because I'm giving so much to charity, I'm able to itemize every year. But the reality is you can still optimize around that because you're kind of quote unquote wasting the standard deduction by not being able to use it. And so again, we can use an itemized deduction. We can use a donor advised fund to group all those itemized deductions into 1 year, and then we can take the standard deduction in those other years. A little bit harder concept for a client to understand, but we can model it in Holistiplan and show them with the donor advised fund explainer. So in this case, let's give the client, I gave them $40,000 of annual charity. So for a married couple, that's plenty for them to be over the threshold of the standard deduction. So they're always going to be itemizing. But let's look at the case of a donor advised fund. I'm going to say the charity is, the standard deduction never gets used. I'm going to choose that choice right there. Their typical every year is $40,000 in charity. Their other itemized deductions are $10,000. Let's group charity of 5 years into one, and then we're going to leave the standard deduction like that. This report will show us that yes, if they just never use a donor advised fund, and on the left-hand side here, just give the way they've been giving, yes, they will have an itemized deduction every single year, no problem. But on the right-hand side here, I'm grouping all of that charity into 1 year, which then allows me to take the standard in those other years, which I'm kind of wasting otherwise. And if you actually add it all up, the total deductions left and right, pretty significantly different. $102,000 of additional deductions over this 5-year period that I'm able to realize because I'm using this donor advised fund to group my charity into a single year. If your client is eligible, meaning they're over age 70 and a half, they can do a qualified charitable distribution from their IRA. It's a great planning opportunity. It's a tax-free withdrawal from this tax-advantaged account, which otherwise would be taxed as ordinary income. It satisfies the required minimum distribution for them if they are of required minimum distribution age. But it also does more than that. It's more than just a tax-free withdrawal. It also lowers AGI. So it's preferable to taking a taxable distribution and then capturing the donation on Schedule A because it lowers AGI, which could impact things like Social Security taxation. It lowers the modified adjusted gross income, which impacts their taxation potentially of net investment income. And so that's a piece that may be a little challenging for clients to fully understand. They've spent their whole lives donating to charity, capturing it on Schedule A as an itemized deduction. And now this other option presents itself, which is potentially a little bit more work because instead of them just writing a check to charity, we're now having to make sure that money comes out of the IRA. And so they may need some explanation of why it's beneficial to do a QCD versus the old way of doing it, which is just give cash and then mark it on Schedule A as an itemized deduction. But we can capture this within Holistiplan. So here I've got a client who's got $100,000 of distributions. What I can do is I can say, well, let's take away, instead of this $50,000 coming out in a taxable way, let's give them $50,000 of QCDs. I got to yank out this $50,000. Holistiplan, first of all, automatically will calculate both ways. Like it'll say, okay, here's the tax with what I have on screen here, but also what if I were to do the other route, which is take a taxable distribution, add this charity to Schedule A, and then it calculates the entire tax bill that way. The difference, the savings here is, well, you can see it right here on screen, right? So savings versus taking a taxable distribution, then donating, it would be $7,000. Savings versus a taxable distribution. So like if you just didn't even donate, if you just took $50,000 off and spent it, like there, it's a $14,000 difference. So pretty sizable difference if you do a QCD versus the other way, taking taxable distribution and donating it. We have an explainer that can show that side-by-side difference. Again, this explainer is meant to be client-facing, give some information on what the maximums for QCDs are and what the rules need to be, how does it work, the actual kind of mechanics of how it works. But then we actually show on screen, like, here's that side-by-side calculation. Here's if you did a taxable distribution and then itemized it, versus here's if you took the QCD and had that run through. And there we show the difference in tax is that $7,099. I think it's a pretty compelling way to show the client in a simple way, look, just this one little mechanical change, the way you give to charity now that you're 70 and a half, can give you some pretty sizable tax benefit. That's all the ways to incorporate charitable intent into your tax planning strategy. I think you'll find that Holistiplan scenario analysis screen is a great way to model out each of these different strategies and show your client the benefit of doing so. And you're saving them money and you're looking good in the process.